Hello and welcome to Dialogue. Since Donald Trump launched his erratic tariff policies in early April, global financial markets have taken a hit and countries are rethinking their trade relationships with the U.S. So does the sharp sell-off in U.S. Treasury bonds signal a loss of confidence in the U.S. dollar and perhaps the U.S. economy itself? What's the likely endgame of the U.S. tariff war, and how will global trade adapt in response? To explore these questions and more, I'm joined by Denis Depoux, Senior Partner and Global Managing Director at Roland Berger, a leading global strategy consultancy. That's our topic. I'm Xu Qinduo. Welcome to Dialogue, Denis. Well, let's start with the tariff war. Of course, Trump has talked about the purpose of having this tariff war to reduce trade deficit, U.S. debt issue, and bringing manufacturing jobs back to the U.S. What do you make of his, let's say, trade war here with so many countries around the world?
I would like to get things right first. Globalization is not just a side effect. It's a choice. So the reason why the US has trade deficit with China, a lot of Asian countries, Europe as well, Mexico or Canada, is not because those nations or regions would be better than the US. It's because the US has made a choice towards globalization. And this does not date back yesterday. This is a choice after World War II. To organize the world, to organize a rule-based world economy, searching the maximum competitive advantage of nations, particularly driven by labor and labor costs. And that drove basically Asia in particular, becoming the manufacturing powerhouse of the world. To the great benefit of the US and Europe, to a large extent, by basically importing increased purchasing power, importing deflation in a way, for all types of goods, thanks to having relatively lower costs manufacturing in China, in Asia, or elsewhere. So these are the basic principles of globalization. So there is no judgment whether this is right or wrong. This was a choice that was made in Bretton Woods, then the General Agreement on Tariff and Trade, which led to the creation of the World Trade Organization. This is the world that we've been living in, and that has had, of course, many problems, but also many benefits, particularly to the US economy. So now, of course, it's not totally new with this new Trump administration that thinking of reshoring some manufacturing is a good idea. It has come from the COVID crisis with bottlenecks in supply chains and identifying dependencies. So I think a lot of shareholders have said, okay, can we reduce this dependency? And obviously, the rising concern of economic sovereignty and sometimes strategic sovereignty, so commending some industrial sectors for the greater good of the economy and one nation. I think these are all sort of acceptable concerns or issues. And of course, now thanks to automation of production system, labor cost is not the driving factor for many industries, not for all industries, but for many industries, for many manufacturing topics, labor cost is not the driving factor. So reshoring is not impossible, but we cannot do that overnight. And it probably doesn't make sense. It doesn't make sense either, because does it make sense to repatriate the whole production of smartphones to the US for one of the makers, or Korea for another one? I will not name the brands here. So it does not make sense, because we have very efficient production system that rely on different capabilities that have been built in industrial clusters. So the whole rationale of the trade war as it is presented doesn't make total sense, but marginally, I think it makes sense to also think of reshoring some industries. And it's not only the US. I think other industrial nations or other nations that have lost of some manufacturing over the last 20, 30 years are thinking of reshoring, either again to abide by economic sovereignty concerns, but and reduce dependencies in some cases. It does not necessarily mean that we knock out the system that has been so beneficial in the last decade.
What about this idea like having a trade deficit is somehow a negative thing, a bad thing, or having a surplus is a good thing? It's like, oh, you are richer than me.
Well, again, I think the whole U.S. System is based on having a trade deficit that is happily financed by the rest of the world, because all of these exchanges are made in U.S. dollars. So I think almost 60% of trade exchanges in the world are using USD, not only with the US, also with the rest of the world, and so that makes the US dollar the sort of reference currency above all other currencies. That basically makes the rest of the world finance the deficit, the budget deficit of the US, and the US continuing to import deflation from the rest of the world, thanks to these global supply chains.
Yeah, you said that before, like policy uncertainty in the US can be even more damaging than the tariff themselves. So tell us more on that. We see, of course, like Trump will change his policies rapidly, sometimes a couple of times, even with 24 hours probably a day. So uncertainty to business and to policymaking and probably to other countries in dealing with the US, for example. How bad is that?
Uncertainty is very bad for company decision makers. Investing entails a certain stability of the conditions, because an investment for my clients, for Roland Berger clients, an investment is based on a business plan, and the business plan is taking a certain number of assumptions around the economic conditions, and there is risk, of course, in taking those assumptions. But like you said, when policy is changing several times a day or a night, depending which time zone you're operating in, it's very difficult to make decisions. So what we see from a number of clients is simply posing decisions. So wait and see attitude, because how can you decide an investment? So it's producing in a way the exact adverse effect from what was expected, because you would expect that company leaders say, okay, then we need to repatriate production in the US if that is the purpose and the way around the tariff. But like we said before, it's not something you can do overnight. You need a plan. It's additional capital expenditure. So it needs to be profitable, and you need a stable environment for this to be profitable. How can that be if policy making is so versatile as we have seen? You know that the Biden administration had put together this very advantageous fiscal package, the so-called Inflation Reduction Act, that was basically subsidizing with tax cuts companies that would invest in production in the US. So a lot of projects were decided during the Biden administration based on the framework, the 12-year framework. 12 years is quite often for a capital-intensive industry. It's a sort of minimum time framework. A lot of investments were decided. Those investments now are on pause because the Trump administration has suspended payments or the tax cuts related to Inflation Reduction Act. So you have sustainable aviation fuel projects, for example, hydrogen projects that were based on this framework that are now in limbo just because the policy has changed or the policy may change. And at least for the moment, the subsidies are basically on pause.
Well, uncertainty hurts investment. But what about the country-to-country relationship here? For example, the U.S. reached a deal in the first Trump term, with Mexico and Canada. there's a trade agreement, but it was his second term. Basically, he forgets about this agreement. He imposed tariffs on Canada, Mexico, also like with South Korea. They had an agreement about, for example, military base. Now he's talking about military base spending should be included in the agreement in the new talks. Things like this, because of this, rapid changes. I mean, other countries feel like even we are able to reach a deal with you, you may change next month or who knows, next year. So there's also uncertainty, right?
It's indeed uncertainty across everything. So it's corporate decision making, it's national decision making, it's economic policy decision making. So I would say it has two effects. The first one is it decreases the credibility of the US and the US signature. And we've seen the impact on the treasury bonds market, the volatile impact on the treasury bonds market. That's the first thing. So credibility. I think everybody is still convinced that the US is a affluent, very important market in the world. But the credibility of policymakers is hindered by this versatile policy making. That's the first sort of adverse effect of this policy. The second effect is also de-risking the US. We've talked a lot about de-risking China in the last few years. For good and bad reasons. So geopolitical tensions on the one hand, and also reducing dependencies, which again is part of the new normal of global trade and investment. I think now the discussion will be about de-risking the US, because if the US policy making is versatile, cannot be fully trusted, again, it does not change the attractiveness of the US as a market. It does not change the strength of the US as an innovative nation, although some of the policies do hinder that as well. However, it means that being fully dependent on US technology, US markets, US consumers, for example, may not be the right choice. So I think some companies now are starting to think of de-risking the US by diversifying their outlets to other regions. And that's not only Chinese companies, that's also European companies, for example, and de-risking the US as part of their global supply chain.
Mm-hmm. Yeah. Mm-hmm. Let's take a look at the, Asia, China and Asia. You have repeatedly emphasized the trend of, quote unquote, profit reinvestment of foreign companies in China. And you have referred to China and all of Asia as a beacon of stability in the era of global uncertainty. Tell us more on that.
Well, we have a lot of domestic demand in Asia. That's true in China, of course, but that's true also of other nations in Asia. And even though I think the Chinese government is not so happy sometimes about domestic consumption and has made efforts to boost it, still it's there. It's a vast reserve of domestic demand in China, across Asia, also driven by population growth, by also population becoming more affluent. That's true for China, but that's true also for Southeast Asia nations, for example. And that's a vast reserve of demand that can be leveraged. And what we see happening is a lot more circularity in Asia. So it's not only China being the factory of the world, it's actually Asia still being the factory of the world, driven by Chinese companies that have offshored to the rest of Asia. And it's Asia for Asia as well. It's Asian production to serve Asian customers that are becoming more affluent. And that, I think, is a pillar of stability for the world economy, because irrespective of those tariffs with other regions, I think I would not call it a haven, that would be probably an overstatement, but it's a good pillar of stability for companies. And we see a lot of our Roland Berger clients actually reconsider the place of Asia in their portfolio of revenue growth. Asia was always a good driver of growth. There was this movement to de-risk China and maybe try to find more outlets in the US. Obviously, this will not be the case, at least in the short term. Therefore, Asia is gaining momentum.
Asia is gaining momentum. It's sort of in line with what your analysis, in your earlier analysis, you point out that the world is shifting from U.S. dominance to a regional balance of power. And of course, we mentioned about in China plus one, basically. Can you explain this further? Regional balance of power or regional integration here?
Sure. Again, let's take the example of Asia. What we have is an Asia supply chain integration. So I would not say that this now supersedes the integration of China and Asia in global supply chain. That is still probably the dominating theme, but we see that part of it is becoming an Asia supply chain for the world and for Asia itself. And that's taking Asia as an economic ensemble that is important for itself, a bit irrespective of the rest of the world. And we're going to see this. We're going to see a multipolar economy with Asia, EU, India, of course, Americas, or probably North America. We're going to see the BRICS countries, all these regions trading with each other, probably with less of ubiquitous world economic order like we had before, until it's rebuilt. And meanwhile, probably the rise of bilateral agreements, regional agreements, think of Asia RCEP, that has created a platform for more integration. CPTPP as another platform around the Pacific. Think of possibly the revival of the comprehensive agreement on investment between Europe and China. So these will be bits and pieces to rebuild this world order, with probably also more investment than trade as a point of focus. We see it. Chinese companies, our clients in China, are increasingly willing to invest overseas. Of course, part of it is to go around tariffs, but part of it is also to become true multinationals. To be able to serve their clients with proximity, to understand the destination market, which is not something that you can do when you simply export from China through agents and distributors in Europe or in the US.
Well, thank you, Denis. Thank you for speaking with us.
Thank you.
Earlier, I spoke with Jens Eskelund, president of the EU Chamber of Commerce in China, about China-EU economic and trade cooperation, as well as China's further opening up to foreign investment.
What China has been very good at through these efforts is to create a convincing case for foreign companies to move their manufacturing to China. So a lot of initiatives really geared towards creating a stable foundation, creating stability in the system, and that's very, very positive. In many ways, high quality productive forces are already here. When you look at, for example, what's happening with EV, with batteries, with green tech, and many other sectors, right, where China is really at the forefront today.
Welcome to Dialogue, Jens. We have seen the Chinese government rolling out a slew of policies to help grow the economy. What impressed you the most? How do you look at the policies?
I think a lot of the things that have happened were timely and necessary in order to bring stability to the system and rebuild confidence in the future prospect of the economy. What we have seen primarily have been efforts so far to alleviate local government debt. We have seen support for financial institutions, and we have seen support for developers so that they can finish these apartments that people have already paid for. So a lot of initiatives really geared towards creating a stable foundation, creating stability in the system, and that's very, very positive.
This overall, let's say, macroeconomic this situation, as you mentioned, of course, the government is doing to stabilize the property market, of course, to dealing with the local debt problem.
Yes.
Are you confident those problems will be resolved maybe in the near future?
I'm sure that the things that are happening now are serving to fix immediate issues. What we think in the chamber also needs to happen is that there is a look, really a firm look at the economic model. The Chinese economy has to a large extent been characterized by being investment-driven. Investment still comprises a very high proportion of the Chinese GDP. We have also seen the state sector being very prominent, and public procurement actually being much larger in size relative to other countries. And we have seen it being very much relying on export manufacturing also. We think that maybe instead of focusing so much on the investment side, in particular in investment into manufacturing, where maybe it's difficult to sell these products because there's no real demand in the market, that maybe some of these resources could be allocated towards the demand side, and some of these initiatives that could rebuild confidence and could help people feel more confident about spending some of their savings. So maybe in addition to sort of look at how you stabilize the foundation, you should also begin to look about, how really can you start that consumption engine again, that demand side. And that, we think, might take sort of a look again whether sort of there needs to be some adjustment to how China works systemically today, in particular in how resources towards investment are being allocated.
Mm-hmm. We'll speak of this transformation of the economic growth model, from relying on investment, export, property sector to now China is moving obviously to, using this catchphrase as new productive forces.
Yes.
With a focus on science and technology,
Yeah.
upgrading of the traditional industries. How do you look at the efforts?
I think it has been a long process, and I actually think in some ways new quality productive forces is not something new really, because I think, I've been in China since 1998, and I can see sort of the composition of China's manufacturing, the composition of China's foreign trade has changed dramatically. And I think China has made a very conscious effort to climb the value ladder and creating ever more sophisticated products. So I think, in many ways, high quality productive forces are already here. When you look at, for example, what's happening with EV, with batteries, with green tech, and many other sectors, right, where China is really at the forefront today. I think that, of course, creates some issues from Europe, because a lot of these are sectors now where Europe and China will be competing head to head, because these are areas where Europe traditionally has been strong and where China is emerging as a very significant contender. That was not the case 10 years ago, because China and Europe were not competing in these same areas, but that you're beginning to see now. And that's where I think that there actually is a potential for an increase in tension unless Europe and China find a way to begin to talk about these things.
Yeah, we'll touch upon that a little bit. Of course, at the same time, China is. We are seeing, for example, recent efforts to open further the market, like in the manufacturing sector. Basically, there's no restrictions in whatever sector there.
Yeah.
Of course, they're trying also to have this practice of a negative list in the service industry.
Yeah.
How do you look at those efforts?
Yeah, I think what China has been very good at through these efforts is to create a convincing case for foreign companies to move their manufacturing to China, to vertically integrate their value chains in China. And that's, of course, very good for China. It creates jobs here. Companies are moving their R&D here. They are paying taxes. They are localizing supply chains. That's very, very good. I think where the problem arises is perhaps in Europe, where they think, hang on, wait a minute. Why is it good for Europe? If you take a European factory and you move the manufacturing to China, what's in it for Europe? And I think that's sometimes where you begin to see sort of the seeds of contention growing, exactly because it is not longer evident that it necessarily is in Europe's interest than if you have. And that's where I think we need to have a look at again, what is the value proposition for both China and for Europe. We still think, of course, that there is tremendous value being created by European companies in China, European subsidiaries here. But I think we need to recognize that value is not universally recognized in all places. And maybe also take a look at how can we make sure that sort of the benefits of globalization of these interdependencies, of this interaction, that they are sort of being distributed in an equitable manner between trade partners.
But people would say, the European countries could open further too to welcome the Chinese investment, to set up factories in their land and to create jobs and pay taxes, right?
Yeah.
So that's a good competition.
Yes, and I think Europe should consider that. I mean, just like China has done, I think that Europe should consider what are the conditions under which that Chinese investments in Europe could actually create benefits similar to. You should remember when the automotive industry came to China here, right? They were told to hand over 51% of their equity to a local partner.
Joint ventures, right?
Joint ventures. That was a requirement. Or else you had to pay a 25% tariff to import your cars. I'm not suggesting that Europe should do that, but we have seen how European companies here have fully localized their supply chain. They have localized their employment. They pay their taxes here. They do their R&D there. I think if Chinese companies did the same in Europe, I think you will find actually a quite welcome audience. So maybe there are some experiences here that European companies have had in China that Chinese companies can use in Europe. I think the key point here is that we should always ask ourselves, as we are doing in China, we as European companies, we are always asking ourselves, what's in it for China? I think maybe Chinese companies also should ask that question, what's in it for Europe? And then maybe we can find a platform.
Well, they are going overseas. I mean, European market is one of the most important market for them. Of course, I'm thinking about the future of the Chinese market for the foreign businesses, including those from European countries.
Yeah.
So they are, you still think so? They're committed, stay on?
I think if we meet again 5 years from now, then I think you'll find that it's pretty much the same number of European companies in China. I think the challenge right now is that European companies are beginning to consider additional investment. Should that be in China or should it be somewhere else outside of China? And I think right now, given the domestic economic situation and some of the other things we see, trade tension, geopolitics, what have you not, has as a consequence that some of these additional investments are now being made outside in China rather than inside in China. And honestly, right now, we don't see a lot of new companies coming into China, which we think is a pity because we still think that there is a significant future potential for European companies in China. So we hope again that sort of some of the things right now that are pain points, bottlenecks for European companies, that we'll be able to fix that over the next few years, and then maybe we will see a positive change in investment levels in China.
Thank you, Jens. Thank you for
having me.